Okay, folks, hi, this is Joe Gordon with Gordon Asset Management, LLC, and today I'm going to bring to you a brief webinar on an update in the investment markets in managing through this coronavirus crisis that we have. So this is the first of a series that we will be posting every week, usually Monday or Tuesday of each week, and the data will be valid or accurate as of the previous Friday for the most part. Our goal is to give you one source to get all the information you need to know what's going on as this stay-at-home shutdown economy starts to open up once again, and the impact on you and your investments and the marketplace in general. So let's get a quick review of what's happening. Well, you can track the cases here on this Johns Hopkins website to see what's going on all over the world and the peak cases and how many deaths and all those sorts of things. So that's a good website source for those that really like looking at this stuff daily or every other day. So when you look at the cases continue to multiply, you see the U.S. over 700,000 cases, about 25,000 a day. We have more cases than Spain and Italy, France and Germany. The interesting thing about Spain and Italy is because of their healthcare system strains, is that many of those over 80 years of age were told to stay home and basically just die. They did give them morphine. So not to be sarcastic, but it almost feels like their cases peaked because they ran out of 80-year-olds that passed away. As far as Germany, they've had the best results. France has been good and not so good. And then I think they've had a rebirth of some hot spots there as well. So we have some known unknowns, and that's what create markets volatility. It's going to be difficult to really know how this is going to play out over the next several months. It seems clear that most people think that you have to have testing, and testing has been a problem, getting that rolled out on a mass basis in the U.S. Some people are cynical that the virus doesn't respond to increased temperatures. Singapore just had a sort of a setback in that case. And that's a very, very hot spot, 30 miles or so from the equator. But anyway, when a vaccine is going to be developed is an unknown. We don't know. There's so many biotech companies working on it. But basically, the market distress is mostly related to the uncertainty. It's not that we have underlying economic weaknesses, the uncertainty around finding some way to stem the virus and work towards a cure with everyone being tested. So let's look at the aid package, and this is a moving target. Overnight, last night, apparently we have another additional round of the small business stimulus of a $450 billion, I think is what I heard. But you can see here that the CARES Act was passed and signed into law March 27th. $500 billion in company loans, $350 billion for small business. Now it turns out in the small business package, some public companies went there and got money and are being outed and giving some of it back. Shake Shack was one that came out and said that they're giving their $10 million loan back. Also learned yesterday that Harvard got a loan through that program, which is kind of crazy since they have multi-$100 billion endowment fund. But nonetheless, here's a summary of the package. You can see $600 a week, up to $600 a week federal unemployment assistance. You can only get that when your employees apply for unemployment through your state, and then that's an add-on. And I hear that's not worked so perfectly, and systems have been strained. $198 billion to tackle the virus, and then you've heard a lot of folks have heard about the payments to individuals that are eligible, up to $1,200 per family member. And a household, husband, wife, and then $500 per child, and there is an income phase out on that. But basically, in the CARES Act, you can see here's the cash payments: $1,200 individuals, $2,400 married couples, and $500 for every child under 17. The income limit $75,000 if you're single, $150,000 if less. And we have an example here where if you make a little bit over that, $180,000 of adjusted gross income, there is a phase-out threshold. And in that particular case study, you can see that couple would receive $900, not $2,400. And so in this act, they've also increased charitable giving, a new $300 above-the-line deduction, meaning that there's no income test. rather than being an itemized deduction, just to encourage people to continue to give to charity. So this makes a lot of sense, especially for those that only use the standard deduction and don't have large charitable contributions. But also, there's no adjusted gross income limit otherwise. It used to be 50, actually it's 60 under the Tax Cut and Jobs Act, but it's basically unlimited for the time being. And then also, corporations can do more charitable and deduct it. And again, these provisions are meant to encourage people to continue charitable donations to non-for-profits in this time of need. And obviously, there's some planning opportunities here. And if you have any questions, reach out to us and we'll try to be of help. So you've heard, a lot of people have heard about the term no one had ever heard of until March 27th, the Paycheck Protection Program. And this was the federally guaranteed loans, which basically are facilitated or administered through a bank or a fintech non-bank that's gotten approved. And again, the goal was to help small businesses have cash flow to continue to employ their employees, even if their employees were under stay-at-home orders. And basically, it's related to payroll costs for the previous year, less than 500 people. And essentially, what you have to do with the money, if you want to have it forgiven as a grant, is use it in an 8-week period starting on the loan's origin date to pay your employees. And basically, Secretary Treasury Mnuchin has said he hopes it covers about 50% of the workforce. But as we now know, in hindsight, they ran out of money within about a week and a half, and a lot of people who applied were told, sorry, we're out of money until this new legislation is about to be signed today, I believe. So talking about what happened to PPP, already kind of got ahead of myself a little bit. You can see the sources here where the loans went. They're out of money, but as we said, replenished with $450 billion, close to that amount, approved yesterday in the Senate and apparently in the House today. So 250 is kind of a small number. It was expanded, and you can see where the loans have gone so far. But the largest states were California, got the most money, and there's really no rhyme or reason why certain states had more success than others. It had a lot to do with the readiness of the banks. Bank of America was the first one that processed, I believe, on the first day it was open, 60,000 loans. It is worth saying that the SBA originated a record amount of loans in 2019, over 28 billion. So to ask them to process 349 billion in a couple of weeks, that's quite an achievement if you can pull it off. So payroll tax credit, I won't get into this too much except to say there is a refundable payroll tax credit available under the Act for those who are eligible. And essentially, you can see on the slide there how it works. It's based on wages paid to the employees, and it can include health benefits, et cetera. And in some ways, this may be more advantageous than even going through the payroll protection program for some companies. And you see here on the payroll tax deferral for small business, the exception for those who have had their debt forgiven. And most of the people we talk to, they want to get the paycheck protection money. They want to keep their employees, at least for the 8 weeks required to have the loan forgiven, and then address the situation after that. If their business still is underwater, they may have to then have those employees furloughed and go on unemployment. But anyway, as you can see, you can defer some of the payroll taxes in the first bullet, and then you can have some of those deferred all the way to 2022 and 2021, a portion due, and then the rest due on 2022. So one of the biggest questions that we get is, how is it that the Fed can print so much money and expand their balance sheet to the largest it's ever been? And isn't there going to be a day of reckoning for this? And that's very true. That's the known unknown type question, because there are a lot of theories about what will end up happening as our debt exceeds 90% of GDP, which is known to be, from history and international and U.S. studies, as a potential warning sign for future economic growth. You see here on the slide the various programs listed, and it's graphed there by color, and you can see that it's going to record amounts, pushing 9 trillion, potentially up to 10 trillion. And one of the concerns we have is that, what happens when your federal debt goes north of 25 trillion? I mentioned the 90% threshold. Yesterday, I saw a study by a very famous former chief accountant of the Dallas Fed, Lacey Hunt, who puts out a quarterly newsletter, that the projection is that this debt as a percentage of GDP can approach 140%. And the warning sign there for us, all of us as investors, is that could be the end of equity price appreciation, because so much of future growth has been borrowed in the form of this massive amount of debt. So having low rates like we've had has enabled us to kind of skip by. But if something happens, if interest rates rise or inflation occurs and profits are hurt, future stock price appreciation is going to suffer. Right now, if you watch CNBC and other finance business shows like Fox Business, most of the talking heads refer to the fact that, it doesn't matter how much debt we have. Interest rates are so low, we can just print. There's no day of reckoning. But in history, that's never been the case. It's just a lot of people don't know what is going to happen. We've never seen this movie before. So the VIX, which is a gauge of volatility in the U.S. stock market, surged to an all-time high, over 80 and up to 85, actually, back in March. And as the market suffered its biggest rout since 87, for most of us on the call, some may remember in history there was a crash in 87, but to put that in proper perspective, in 87, the market was up 44% in August and peaked. And then when it crashed, it went down 20% in a single day in October. Yet it ended up the year, calendar year, up 5%. So when you tell this to younger folks investing, they go, well, in the history books, it shows there wasn't a crash. The market was up 5%. And we like to remind people, and so when people got fearful that market went up too far too fast, they could have easily sold. And back then, Treasury bonds were yielding 9%. So that's a pretty nice safe haven. As of this morning, 30-year Treasury bonds are yielding 1.16, and the 10-year Treasury down to 0.56 as of yesterday's close. So essentially, you can see the fear gauge. The good news is, if you look at this slide, you can see it crested in mid-March, and now it was down to 38 Monday, and I believe it went up to 45 yesterday. So still, the VIX is at elevated levels, which tells you to expect huge volatility and swings day to day. We've had 2 down days, Monday and Tuesday of this week. The futures are up this morning, and this is kind of the yo-yo bounce we've been on since late February, early March. So last week, the S&P was up 3.3%. Everybody was feeling great. On Friday afternoon after the market closed, you can see a rebound of 16% in April and only down 11% year to date. The misnomer about the 11.7 is that 6 stocks make up 22% of the S&P index, and most of you know who they are. It's the FAANG: Facebook, Apple, Amazon, Netflix, Google, and add Microsoft. Those are the 6, and they were up 4% year to date cumulatively last week, and everybody was chasing those big names. Well, they had their first cracks yesterday and started to sell off. So if you took those 6 stocks out of the S&P index last Friday, the index would have been down. The rest of the stocks were down 22%. So, looks can be deceiving, but it's important to know that 6 mega tech stocks basically are 22% of that index. So the other thing that concerns folks is that in less than a half a month, the S&P's retraced over half of its downturn. That's historically not the case normally. You can see that in the third bullet that usually takes 5 and 7 months to retrace 48% of the losses. And so the market went down at a historical rate in the decline, but it also has rebounded and snapped back. A lot of people call that, we think we're going to have a V-shaped recovery, a snapback. Once the economy turns on, you flick a switch. A lot of people are not so convinced that's going to happen. That's why you're going to continue to see volatility at the rate that you have. Just got ahead of myself a little bit. That you can see here that is the market recovering too quickly. Who knows? We've never been into a global pandemic. Everyone talks about the Spanish flu of over 100 years ago, but essentially, the market's going to be a forward-looking indicator, and usually will rebound in anticipation of a recovery. So you see this event-driven bear markets generally last 9 months and don't recover that fast. The average length of a structural bear market is 42 months with a drawdown of 57% or a negative 57% return. Cyclical bear marks in point two are generally 27 months, an average of 31. Well, this is event-driven. And so, and 9 months and a minus 29. So who knows who knows if we'll be able to get out of this? Because as a lot of people know, the average person probably won't be going on a cruise in the next 6 to 12 months, might not even fly. And when 9/11 happened, it was 3 years after 9/11 before people flying in airplanes equaled the same amount of volume of traffic as it did prior to 9/11. So this is a technical indicator. A lot of people that believe in technical analysis always look at the 200-day moving average of stocks. That kind of tells you about the momentum and what's going on. And the majority of the stocks are not even performing close to their 200-day moving average. That's really no surprise because this is a global pandemic and we shut the whole economy down, or the whole world down in particular. So the number of stocks trading above their 200-day moving average, less than 30%, no surprise. And that's higher than the 2008 levels. But 2008, the story why that happened is a whole different story. And so basically, we haven't exited the bear market. Now, here's another indicator that essentially tracks jobless claims, mortgage apps, high yield bond spreads, and other things that indicate turning points in the economy. It's important to know that 6 of the last 7 recessions dating back to 1967 were preceded by this measurement gauge, ECRI. I think it's the economic recovery indicator going negative. So basically, you can see it's at its lowest reading in history. So that is a good reason to beware. Then you got the weekly economic indicator graph, and you can see, okay, well, the only 2 times it looks awful is back in 08, 09, and now in 2020. And that indicator uses unemployment, staffing association index, user fuel sales. Well, nobody's using gas, as we know by the price of oil in the futures market going negative, raw steel production, and et cetera. So essentially hadn't been this low since 08, and it's even lower than it was in 08. So everyone's talking about GDP in second quarter, Q2, and says there may be hope if we have a V-shaped recovery in Q3 and 4. To the right, you can see various financial institutions and what their guesstimate is for the second quarter. JP Morgan, minus 25%, Goldman Sachs, minus 34%. Again, it's hard to guess what this is going to be. One thing we already know, the market's priced it in. It's going to be awful because everyone sat at home on their thumbs for the most part, except the healthcare workers fighting the virus on the front lines from mid-March until even today as we speak, April 23rd. So China's GDP, switching gears, is contracted for the first time. A lot of people don't put too much credibility in their numbers, but they did admit it shrunk 6.8%. And, their return to normalcy hasn't been completely successful. But also, it's worth noting that over the weekend, they revised the estimated deaths in Wuhan province. So, there's just a whole credibility and accountability gap on looking at Chinese data in the first place. But one thing for sure is back in 2008, they went to extreme measures to prevent the economy collapsing, and they'll do the same again, which is really probably throw a lot of money at the problem. So here we have record jobless claims, and people say unemployment may reach 20. I've seen some studies saying it could reach 30, a third of the workforce. We haven't seen these levels in a long, long time, probably dating back to the Depression in the 30s. 5.2 million people applied for it a week ago. There's 22 million applications since this whole thing began for unemployment. And some people think we've passed peak unemployment. I'm not so sure. And then, of course, for all the people getting this paycheck protection money, once 8 weeks of salary payments are made, what next if the economy is still pretty much not moving? U6 is a measure of unemployment that takes underemployed workers into account, and also it's worth noting that this data point does not include people whom they say are not looking for a job, just underemployed. There's this term engaged became much discussed in 2008, 2009. But again, the last time it was ever this high was 2008. So that's something to keep an eye on. Next slide. So COVID, does it hurt business? COVID-19. Of course, you can see here, it's very easy to see. Everything is to the downside. The services PMI, since 77% of the U.S. GDP is attributed to the service economy, is plunging to significant historical lows, at least especially since the financial crisis of '08. So basically, financial stress indicators are moving towards the previous financial crisis all-time highs. You can see here that basically the one thing that's different this time is that the Fed did not sit on their thumbs and try to figure out what the playbook should be. They acted very quickly and decisively with the CARES Act. We'll see how that plays out. And I think a lot of the reason why the market has rebounded and snapped back so much is because of the fact the Fed has basically pulled out every weapon they could ever think of, including even they buy a lot of mortgage backs. They're buying high yield bonds and debt ETFs. They've never done that before. And some naysayers are saying when you buy high yield debt from companies with not such great balance sheets, that you're one step away from buying stocks, which is what Japan has done for 30 years. But only in the last 10 years or so have they actually bought stocks, but they've been in a 30-year bear market. So a lot of people, the smart money, hedge fund people, financial institutions are really talking about the bond market, and the bond spreads being the canary in the coal mine simply means that you've got a lot of cracks in the financials of companies that are generally not investment grade, or maybe they're triple B rated and below. And currently the spread is 883 basis points over treasuries, and usually it's 4%. But back in the financial crisis, it's worth knowing that the spreads got up to 21%. In fact, one thing as an opportunity set to think about this particular indicator is the high yield bond index, is that in 2009, when the economy rallied, the high yield bond index, just the index itself, was up over 50%. But then it was down so bad, nobody would buy anything, and you couldn't catch a bid in 2008. So we've got our eye on that. But obviously, if things stabilize with spreads at 883 basis points, and I think they've come in this week to 770 or so, there's opportunity there, but you have to have professionals who know what they're doing. The energy sector is probably the most suspect sector to go bottom fishing in because of the oil crisis. So why all the stimulus? A lot of people ask, well, small business accounts for almost half of the labor market and almost half of GDP. Small business also doesn't have access to the credit markets to borrow like public companies do. And then also many small businesses can't afford paid sick leave and medical leave. In fact, many of the federal legal requirements on offering or mandating these type things, you have to have 50 employees or more. So a lot of small businesses don't. And then basically a lot of small businesses, they live on cash flow. The cash flow goes away. They generally got receivables of maybe 60 to 90 days or they're out of business. Also, for the first time that this has been not frowned upon, but kind of just generally accepted, is renters didn't pay their April rent. 30% didn't pay as compared to 20 in March. Usually people that do that for a month or two, you go through the eviction process. But landlords are having issues getting mortgage payments, or making them if they don't have rents. The feds have agreed to let landlords defer some mortgage payments. So again, you have the Fed and the Treasury Department coming to the rescue. And it's basically, it's interesting, but only less than 1/3 of U.S. rental properties are affected. Blackstone is the largest real estate operator in the world, and was looking at a March newsletter they sent out this morning. One of the things they said was that even they have abated some debt payments from loans that they have made on properties because those properties are affected with no cash flow. They could primarily, they're multifamily, which means apartments. So here's some interesting data. This is not the Great Depression. If you look at the red bar, when markets are down, the worst ever, you can see only 2 times did the market lose over 25%. So big declines are very, very rare. And even 15 to 22, to 25%. And the pink bar, 2003 was in there, 73, the oil embargo, the first one in the 70s. And who knows where this particular one will end up because of the quick snapback. But also, you can see there the Fed didn't do a whole lot during the Great Depression. And then also twice the government raised rates during the Depression, which extended it in the downturn. But basically, 4 times in the past 70 years have you had a huge market decline. Of course, that doesn't mean we're out of the woods yet, but it just means that maybe not panic at the bottom and sell. That's generally the thing you'll read in most financial trade journals and anything in the financial press is don't capitulate with fear and sell at the bottom. So there is a path forward. So this is the whole alphabet soup about what type recovery. We're not making a bet on what it's going to be because, frankly, we feel that the market has been propped up by all the liquefying stimulus from the Fed and the legislation, the CARES Act, et cetera. So who knows what's going to happen? But you can see this. We're going through the V argument, the L or the U, and then there's the W with some looking to reopen their economies. We'll see. Some states reopening their economies, which is happening this week. And I'm not going to predict anything because nobody knows. Nobody's been through this before. So you get into the buy low and sell high. This is a slide about basically everyone knows you should buy low and then sell high. But the problem is behaviorally, most people don't want to sell when things are high because they're feeling real good about how much money their portfolio is worth. And then when you attempt to time the market by selling after a 30% loss, generally you miss out on the market's best gains. In fact, if you go back to 2008, most retail investors sold at the bottom and they didn't come back in mass till 2012. And then that resulted with so many flows in 2012. The market was up 30% in 2013, with just a rising tide pushing all the boats upward. But you can see in the slide here, if you miss the 10 best days, rather than staying fully invested, you'll have about half as much money. If you miss the 20 best days, a third. And then if you miss the 30 best days. So history shows that no one knows how to time the market. The people that do time it generally once, they write a book and get rich that way. Here is all the shocks, the graphs of the market through time. And you can see it's not a straight line to the northeast. Basically, if you sell and get out, you're going to lock in your losses. We're not saying always stay invested, but one of the things we try to tell our clients is, look, sell into strength. If you don't like the volatility, and right now the volatility is 4 times what it normally is and has been during the secular bull market from March of 2009 through, let's say, the fourth quarter of 2018 or even through February of this year when markets hit their all-time highs. So the time to de-risk is when things are at all-time highs, not when they're at a sharp reversal lows. But you see the trend here, even with the shocks to the system, the depression in the middle of the first third of the graph, and so forth. The trend is always to the northeast in spite of the periodic setback. And this is another slide about trying to time the market and depending on the type portfolio that you're in, and 20-year annualized returns by asset class. Those that try to time it generally lose to inflation, but we don't really have any inflation right now, and I don't think that's the big concern at this particular time. But those that did stay fully invested in the S&P or in bonds, they beat inflation by as much as 4% a year, and that's generally what you want to do to have a real return over inflation of 3 to 4%. That's how you can get wealthy long term. And so the various graphs just show you the volatility, and obviously most folks that are 50, 55 and over will tend to have a 60-40 stock bond portfolio. Some are more conservative, have 40 stock, 60 bonds, and then others somewhere around the curve of those. Anyway, again, not to really keep beating into this, but don't try to catch a falling knife and thinking you got to get the exact bottom. Nobody ever does. The good thing to know from this slide is that there's only 11% return difference between buying in the market at the exact bottom and being 2 weeks early. Over time, there's a 2.6 difference between buying it 2 weeks early and 2 weeks late. So the whole point is, you can't guess it exactly. And even Warren Buffett famously says something to that effect, is that, in the short term, the stock market is a voting machine because people vote with their feet. In the long term, it's a weighing machine. And so you can see here that trying to guess the bottom is fool's errand. So they will rebound. And again, another slide from just the last 50 years. But if you focus on 2000, you see the sharp tech bubble burst. And then you go to 2007, 8, you see the sharp financial crisis burst. And then you see where we are today. So typically the market rebounds from epidemics quickly, though, and that's why people are calling for this V-shaped rally. We had strong fundamentals in the U.S. in particular, and when markets were at all-time high, peaking around February 19th of 2020. So who knows how this will happen? To me, it's a function of how fast does the liquidity injected by the Fed really make itself way through the financial system. So sticking long-term, stay with your program. For those that are clients of ours on the call, we're happy to take a personal call and help you evaluate your situation. The fear in the market really is nobody knows what's going to happen. We haven't in our lives, all of us, been through a pandemic before and seen what that can do. Generally, most financial crises or stock bear markets are caused by human behavior, not by a virus. And then we don't think this is the 2008 financial crisis again, but two things are different by it. That was man-made and really caused by the housing market and some lax regulations, number one, but also the Fed really only responded to those sectors and propping up the banks. They didn't really do anything for Main Street. So I would say try not to get caught up in the immediate, just think long-term, because short-term there's so much noise out there. And with the stock market moving a couple weeks, 1,000 up, 1,000 down every other day, that can almost paralyze you. So Liz Ann Saunders is a chief strategist for Schwab, and there's some good points she makes. You're going to see a higher debt to GDP ratio from countries trying to spend their way out of this recession, potential higher rates later, higher inflation later, higher taxes later. You don't have to be a rocket scientist to figure out, well, if we're going to add 6 to 8 trillion to our deficit, does that not have to get paid for at some point? And normally that may mean higher taxes. Who knows? Also, there's a lot of talk, as everyone knows, about decreased globalization and taking our supply chains out of China. Well, Vietnam's not the answer. They're a partial answer because they are just too small. But a lot of manufacturing, probably, especially in pharma, is going to come back to the U.S. because of the national security interest. So there's going to be a lot more health screenings. Think about people coming into our country and getting through customs, but also how do you get into sporting events and so forth when they open back up. And basically, I think more fiscal caution in governments and building rainy day funds because everybody realized how unprepared they were. And you've seen that state by state and the lack of supplies. And also people will be more cautious or when they're out and about. Like, who is that walking by me? Oh, they just sneezed. Going into grocery stores seems to be your highest risk at this particular time around people trying to practice 6 feet social distancing, but maybe not so much. So basically, how do you prepare for all this? Household plan, obviously some things you can do. Get some basic medications, food, and everything. Don't hoard all the toilet paper. Everyone's talking about. Establish other ways to communicate clearly. Everyone's heard a Zoom video by now, and also heard about getting Zoom bombed. That's been the quickest way people have been communicating, especially businesses working from home. Childcare issues and so forth, and adapting. I would say visit the CDC website also, and just take care of yourself and your family and make smart decisions. A lot of people are getting outside and walking a lot more. For those that live in private country clubs, they're also playing a lot more golf. So at the end of the day, we don't have all the answers. We just know a lot of the questions. We do feel that the market could test the bottom that it hit immediately. And so therefore, there's a cautionary tale because we're concerned once all the stimulus is out there and spent, does the economy really respond that quickly? Who knows? No one knows the answer to this. But if you have questions, we're happy to have a conversation. Simply give us an email at the email on this, or if you have individual emails of mine and others in the firm, you can do that as well. Happy to engage anyone in a conversation. Thanks for your time and your attention. Have a great week. We'll be back early next week. Thank you.